Welcome to our webinar, and thank you for your time. My name is John Wright, and I'm here to help you become better investors. This webinar is designed to be an interactive experience. We are to act as if we're sitting in the same room. That's the goal. I'm here to answer your questions and engage with you. So please don't hesitate to participate. There will be opportunities to do so. We will have several polls throughout the experience. And there's always a chat box in the upper right-hand corner of your screen. Please feel free to submit questions at any time. No one else will see these questions but me, and I will try to get to them. And if I don't get to your questions or comments, I will send you an email afterwards with my response. This webinar is about one-on-many interaction, right? This is about trying to have an educational seminar, but I recognize that many of your questions won't be answered. You will have the opportunity, several opportunities to book one-on-one time with me so that we can review your questions or talk about anything you want to talk about, really. If you want to review your portfolio, we can do that. The time will be yours. Finally, before we get started, I want to encourage you to maximize the value of this experience. And we can do that in a couple of ways. First, we need to focus on the topic at hand. Please don't bury this tab behind a lot of other things you're trying to do. Don't surf the internet while we're having this discussion. I have several slides to go through. Some of them are a little bit dense because this is complicated stuff. Basically, we're trying to protect your downside without sacrificing your upside, and that is very difficult to do. So I'm going to need some focus. Okay, well, let's continue, starting with introductions. So a little bit about my background. I was a chemical engineer once upon a time, so I'm a problem solver. I love analytics. I was fortunate to attend Stanford Business School and rack up a lot of debt. I paid off that debt by consulting with McKinsey, a high-level strategy with corporate America. And then after McKinsey, I worked with senior management in various companies, a wide range of industries actually, to improve their sales performance, their profitability, and ultimately their sales price of their stock. I left corporate America to become a registered investment advisor. And I'm based in Tennessee. I am a fiduciary. You may be familiar with that term. It basically means I need to put your interest above everything else. And I'm audited by the state of Tennessee on a regular basis to make sure I'm doing that. Been featured in various media. You can always Google John Wright Stellar Assets and watch my Fox TV interview or various podcasts and radio spots on the major networks. Now, on a lighter note and a more personal note, about myself, I like to drive fast. I like to travel. And when I'm not spending time managing other people's money, I'm with my family, 3 children, 2 dogs, 1 wife from Brazil. So I thought I'd throw in a few fun pictures. Feel free to fire up that chat box. I said this would be interactive, and I said no one else sees your comments. So if you'd like to slam me for one of these pictures, please feel free to do so, or vote for your favorite. Personally, I like the picture at the bottom with me inside a giant tortoise shell in the Galapagos Islands. But you might find this seemingly cute little dog to be good. She's actually evil, and she earned her name of Mala, which means bad girl. So if you'd like an extra dog, I'm sure she's available. Anyway, that's a little bit about myself. I've also lived all over the country, every major region, and so I'll start with an easy poll just to get you comfortable with taking polls. Maybe you can tell me what part of the country you're from. I've also lived overseas in a few places, Holland, Belgium, and Russia. Enough about me. I'm sorry. One last thing about me. I'm an author. I wrote a book on active equity investing, And hopefully the title is not too offensive. You know nothing about picking stocks, and that's okay. Don't feel bad if you relate to that. Most people, most professionals don't know how to pick stocks either. They don't have a clue. But this book started me down the path of asset management. I was still working in corporate America, and I was looking at the returns I had earned in my personal portfolio, and they were pretty impressive, to say the least. 30% for 10 years, 30% per year for 10 years. So I sat back and I had to ask myself, what was I doing right? Now, one other thing you should know about me is I was raised in the Northeast. And in the Northeast, everyone's a skeptic. Normally, they're skeptics of everyone else. And that fit me as well. I was a skeptic that anyone was capable of beating the market. So I wrote this book partly as an exercise in self-evaluation. I had to prove to myself that it could be done and objectively look at how I did it. Came up with these 10 rules, starting with humility at the top of the list, right? Recognizing your own ignorance, because we're all ignorant. Um, some of these rules are pretty straightforward, and you've heard them before. Buy low, sell high. I've got a reviewer on Amazon who tells me that this book is nothing earth-shattering, nothing new, and that person is absolutely correct. This is not earth-shattering information. The problem is we are humans, and as humans, it's easy to say buy low, sell high. It's hard to do it. Emotions get in the way. We lack the right discipline and temperament to be effective investors. But after writing this book, after seeing my own results, and after managing other people's money and achieving similar results, I have now come to the conclusion that yes, it is possible to beat the market. And I believe following these steps, anyone, this book was targeted at do-it-yourselfers. I believe that anyone is capable of beating the market. More than happy to share this with you. And as a matter of fact, I've got an offer for you on this seminar. I mentioned earlier the one-on-one appointments. The first 10 of you to sign up for a one-on-one appointment, I will gladly give you a complimentary copy of this book. Again, it's made for do-it-yourselfers, but it also highlights my investment philosophy, how I go about managing other people's money. Whether you want to buy it for yourself and your own investments, or whether you want to buy it to evaluate what I might be able to, how I might manage your investments, I'm fine either way. For those of you who don't get in on the first 10, I would encourage you to buy it on Amazon and maybe give me a better review than that one person who said there's nothing new in this book. I'd appreciate it. Okay, now this book only talks about stocks. And there's a reason for that. I don't do bonds. I don't believe in bonds. And if you're protecting your downside properly, you don't need to dilute your performance with bonds. Now, don't just take my word for it. Let's look at the numbers. This is the chemical engineer in me. So this graph looks at 200 years of data. It's a little hard, a little fuzzy to read that. 1802 to 2002 and beyond. 200 years of data. And if you started with $1 and invested it in these various asset categories, what would that $1 be worth 200 years later? You can see stocks by far are the winner, really the only real winner. That $1 would turn into over 700,000, and this chart's a little bit dated, so it's probably closer to $1 million today. So you could have $1 million if you invested in stocks. If you invested in bonds, bills, or anything else, you don't have significant assets. Really, stocks are the clear winner here. Now, some of you might be interested in gold, especially given how gold has performed over the last year. And I actually believe in gold as a hedge against inflation. By the way, all of these numbers are adjusted for inflation. These are real returns. But if you're going to invest in gold like I do. Invest in gold miners. Some of my best holdings this last year have been gold miners. What about cash? Well, cash is the same as US dollar. So if you invested $1, kept it in a US dollar after adjusting for inflation, that $1 would be worth 5 cents today. So it's your choice. You can have $1 million or you can have 5 cents. Well, if you live 200 years. So it's time for another poll. Please consider for a moment um, how big a role stocks are playing in your portfolio. And if you could please just take a second to answer that, I'd appreciate it. Okay. Um, Stocks are great in the long run, but what about the short run? You might be thinking stocks are expensive. And yes, you would be right. And yes, you should be concerned. This slide might be a bit confusing to you. I'll walk you through it. But again, if you want a more detailed explanation, please book a one-on-one meeting. This is known as the Buffett indicator. It's an informal name. It's really taking the total value of all US stocks and dividing it by the gross domestic product. And the theory behind this slide is that the stock market should grow roughly in line with GDP. There's a slight upward bias over time. And so this is the average, and we are far above average today. We are 2 standard deviations above average. 2 standard deviations is 95%. We're only looking at half of the equation. So essentially, we're in the top 2.5% of all-time highs. And that should make you nervous, which is quite understandable. And this is a reasonable way of looking at the world. Bottom line for this slide, Warren Buffett and myself would both tell you that this market is very expensive. But he and I would also tell you that it's been expensive for a while. And we'll take a closer look at the last period that we have here. Poll. Time for another poll. On a scale of 1 to 5, how concerned are you by current market, market valuations? When people are concerned, they ask if they should temporarily turn to cash. Or in other words, can you time the market? And the answer is a resounding no. Many have tried. It makes sense, right? Market's high. I'm going to wait for it to go back down. There are many reasons why timing the market doesn't work. Picking bottoms to get back in, for example, is just as difficult as picking tops. And to time the market effectively, you need to be able to do both right. And truth is, you won't. Emotions will get in the way. And as this slide shows, the value of $10,000 invested over a 20-year period of time grew to $64,000. That sounds amazing, right? But if you missed just the 10 best days, you earn less than half of that. 10 days over 20 years, or 1 day every other year. Unfortunately, so if that weren't bad enough, 7 of the 10 best days took place during bear markets. So you probably would have missed these days. Let's turn to another Buffett quote. Only an idiot tries to time the market. Don't be an idiot. He can't do it, and he recognizes it. I can't do it. No offense, but I don't think you can do it either, and you shouldn't try. But in case you were still thinking about timing the market, let's go back to that earlier slide, to the more recent time period, and do a little thought experiment if you had tried to time the market. If you sold when the market first hit that 2 plus 2 standard deviations, which is early 2021, the S&P 500 started the year at 3714. The market would have gone down and you would have been patting yourself on the back. But it never gets down to average. and it's questionable whether you would get back in over here. So we're going to assume that you don't get back in. The market continues to go higher, goes higher once again. You get nervous. You're not going to get back in at a higher level, especially when it's approaching 2 standard deviations again. So you're going to miss out on this round trip, which, okay, well, it doesn't look like I lost a lot, right? It's only a little bit higher, but GDP is growing this whole time. So if you look at the market a few days ago, it was at 67.52 versus the 37.14. So it's 82% higher. What that means practically is if you took out $100,000 from the market, you lost out on $82,000 in gains. That's what timing the market will do for you. You'll lose out on a lot of gains. One last quote. This one is from John Maynard Keynes, famous economist in the UK. The market can remain irrational longer than you can remain solvent. This market is expensive. It could continue to be expensive for the next 5 or 10 years, and you would miss out on tremendous opportunities, and inflation will eat your lunch. One more poll. What % of cash are you currently holding? So I'll let you chew on that for a second. Doesn't have to be exact. Just think ballpark, 10%. What's the number? All right, so this brings up the golden question. How do we stay in stocks because of the long-term gains, but also protect our downside? In other words, I want my cake and I want to eat it too. And there's probably a rule in giving webinars that you're not supposed to give the answer in the first 10 slides, but I'm going to ignore that rule because there is an answer. Actually, there are 2 answers depending on your risk profile or how much risk you're comfortable taking. And we'll go into more detail on both of these. But for very conservative investors, we use something called regression modeling. I'll explain what that is. But regression modeling can help us steer clear of the most vulnerable stocks in a downturn. So you can enjoy much of the upside without exposing yourself to the most vulnerable potential losers in a decline. And then for the I don't want to say less conservative because I think this also can apply to conservative investors. But the second option is to combine an equity portfolio with options on individual stocks. And I'll explain how options work in a few slides. But the short answer is options can pay off when the market declines. So when the rest of your portfolio is suffering, the option part can benefit, and you can actually make money during market declines, depending on what your proportion of options might be. So we'll talk about a lot of these. There's a lot to chew on here. But I am curious, and I'm going to throw another poll at you. Are you familiar with either regression modeling or equity options today before we get into this? Okay, before we leave this section and discuss regression and options, I want to first give you some hope. Okay. This slide is looking, it aggregates all of the bad months in the market since 2022. So if the market, if as defined by the S&P 500, if the market went down in a given month, it's in this data set. And if it went up, or if it went up, it's not in this data set. So if I look at all those months together, and there were 17 of them, the average bad month, the market went down 4.3%. If I look at stellar equity clients during that same time frame, so these are clients using the regression modeling, they went down by less than 1%, same time periods, same months. Now, I should point out that we'll talk about this with our regression modeling, but we don't just do regression modeling for downside risk. So there's multiple regression models in there. But the point is, you can sidestep market declines or at least minimize the decline in an equity account. With option accounts, and this is equity plus options, although again, during this time frame, the option percent is higher than what I would recommend for most clients starting out. But options, because they pay off when the market declines, the option accounts on average over these 17 months made almost 16% per month. So when the rest of your portfolio is dying, you're celebrating in the options portion of it. I should point out the disclaimers, of course, because these are real performance numbers. Individual investment results vary, investments involve risk, and unless otherwise stated, are not guaranteed. Past results cannot predict future performance, and these performance calculations have not been audited by a third party. But I think you can see a clear trend here that there are options for overcoming a market decline. Again, if this is something you want to discuss in more detail, feel free to set up a one-on-one meeting, and if you're quick, collect that free book. I can also offer a second thing in these meetings, which is you might be curious, how would my portfolio perform, my existing portfolio, in a down market? If you have a portfolio of individual stocks, I am more than happy to use my modeling to look up my projection for how your individual stocks would perform in a down market. So I can do a risk analysis for your existing portfolio. Okay, now let's talk about regression models. What are regression models? What do they look like? How did you come about producing them? First, a definition. A regression model is a statistical model that estimates the relationship between one dependent variable, we call that the result, and multiple independent variables or inputs. It is used to predict outcomes and understand the influence of various factors. Let's walk through an example. Hypothetical example. So let's say we wanted to predict, that's the result, we wanted to predict test scores of students before they actually took the exam. We can hypothesize different inputs that might help us predict that outcome. They might include things such as number of hours that student studied, or that particular student's IQ, or the number of hours they slept the night before. How about scores on previous tests? There's going to be a range of factors that we can include in this model. And then the model, the form of that model would be the test score is predicted to be some constant that we have to calculate times the number of study hours plus another constant times IQ, constant times sleep hours, constant times old tests, etc. I want to talk a little bit about this term at the end because these are not exact predictions, right? Nobody can exactly predict what score someone's going to get on the test, no matter how many inputs you put in here. There's going to be error. The more complicated the system, the larger the error term at the end. These are always approximations, and we can live with that. It's okay. Now, some systems are more complicated than others. In a previous job, working at AutoZone, one of my responsibilities was managing both internal and external data scientists, teams of data scientists, whose job it was to run these regression models and in an attempt to explain same-store sales. So how much would sales decrease if we had 10% more rain, or 1% higher unemployment, or 5% lower gas prices? These are things that affect auto part sales. But it's complicated, and trying to extract the impact of each statistically significant variable and develop that final equation, it's difficult, and you might have a dozen variables in there and a significant error term. But even that attempt at AutoZone, which we did on a quarterly basis, was child's play because price movements in the stock market are infinitely more complex than predicting same-store sales. The error terms are large, but even in the stock market, if we're only right 6 times out of 10, those results can be highly useful when applied over enough stocks. And this is what we do. We start with thousands of stocks, and for each stock, we look at hundreds of data points. So hundreds of thousands of data points in total, and they will be things like debt to equity or recent stock performance over the last 4 weeks, sales growth, etc. We then work the problem mathematically and back into relationships for a given market environment. Like last time there was a major decline in stocks, we can come up with these relationships. We can then use those relationships to approximate next time there's a market decline. How is that particular stock going to perform? And we can, if we choose, we can avoid those riskiest stocks. But as I stated previously, no one knows which direction the market is headed, and there is a performance penalty to be had if you only invest in these, quote, safe stocks. We can if the client is completely focused on avoiding a crash, but we typically don't rely on just one model. So here you can see some of the other models that we do. Will the market drop, or will tech stocks continue to dominate? What about interest rates? Will they continue to fall, or will they rise? What about growth versus value? We build half a dozen different models because nobody knows what direction the market's going to go. My job is to find stocks that are in the sweet spot, stocks that will do okay, hopefully better than okay, regardless of which of these market environments we find ourselves in. I'm not predicting market environments. I'm finding robust stocks, and I'm ranking thousands of stocks based on how robust they will be, regardless of the market. Looking for that sweet spot. Okay, now I know that was difficult to talk about regression. Let's talk about options. Also a difficult topic. What are options and how do they work? Options are leveraged bets on the direction of a specific asset. And there's really 2 main types we're going to talk about. A call option is a bet that an asset will go up. So with a call option, you lock in the right to a future purchase at a set price. If the asset then goes up in value, you exercise the option, buy low at the option price, and immediately sell high. And because it's levered, you actually do 100 shares of stock for any one option contract. So you can make a lot of money in a hurry if the stock moves in your favor. And if it doesn't move in your favor, then you lost the price of the option, but you don't suffer any more than that. On the other side of the equation, put options, they're the opposite, and they pay off when an asset price decreases. Put option will lock in the sales price. So if the stock then goes down, you can buy it at the current cheaper price and immediately sell it for that locked in higher price. As an investor, you don't need to worry too much about the details of how these option contracts work. What you need to understand is that you can place levered bets in either direction, that a stock will go up or a stock will go down. Options sound interesting, but they are highly levered, and many people will ask, is investing in options just too risky? And the answer to that question is a resounding maybe. It all depends on how you're investing in options. On the left-hand side here, if you invest in a single option contract, then absolutely, it is too risky. Because most contracts will expire worthless. You'll lose everything unless you're right in 3 different ways. You're right in the direction the stock is going to go, the magnitude, and the timing. So we don't do You should never do single option contracts. That's like betting on black in roulette, but with less than 50% odds. So, but what happens if we take a bunch of those contracts and pull them together, a portfolio of individual contracts? Well, still too risky for most investors, but the diversification does will yield some winners, and the winners can increase by 400%. Anywhere from, I mean, oftentimes winners are in the 200 to 400% range. Um, and that helps you offset all those losers that are going to expire worthless. So when you diversify your risk across a large number of option contracts, then the risk, it's still high for most investors, depends on your risk profile. There will be large month-to-month volatility. You have to be comfortable with a 30% swing from one month to the next. So if you're that kind of investor, it is possible. But for most investors, the answer is still no, too risky. Well, what if we take that portfolio and we make it a small slice of a normal equity portfolio? Okay, well, so the volatility is decreased even more. Furthermore, the winners from this portfolio often happen when the market declines. And that's kind of when you need those winners the most, right? So when your overall equity portfolio declines because the market went down 5% that month or 10% that month, that's the time when a disproportionate share of your option contracts will pay off. So think of this as two sine waves, one for the equity portion of your portfolio, one for the option portion of your portfolio. And in those darkest hours, oftentimes those sine waves cancel each other out. Or if you have, depending on what percent options you have in your portfolio, the options portion might dominate and you might actually make money in a down market. But that's how you have to think about this. And if you start with a small option percentage, then options are not too risky for most investors, but actually can actually lower your overall risk of your portfolio. Another poll. Think about your own situation and answer this question about how much risk do you find appropriate where you're at today. I'm not going to go into a lot more detail about these options. You can read through some of the ways that we use options. It is, again, a little bit dense. I will stop on the first two of these. So the first logical question that comes up is, how do you know which stocks to buy options on? And that comes back to the regression modeling. So when we talk about regression modeling, that's not just on the equity only side, but also equity portfolio plus options. We use the same underlying modeling to figure out which stocks to place contracts on. And so if a stock is at the top of our list, highly robust, highly ranked, those are the stocks that tend to get the call options. If a stock is at the bottom of the list, not robust, vulnerable, no matter what the market throws at it, those stocks tend to get the put options placed on them because we're betting that they're going to go down. That is difficult for you to replicate at home. We can talk in a one-on-one meeting about how to do that, but it is difficult. Number two is really my most important rule, and this you can definitely do. If you're going to trade in options, you always want to hold both put options and call options. You never bet on the direction of the market completely. You never say, oh, I'm sure the market's going to go up, so I'm going to invest in call options. I set a minimum floor of 20%. So I always hold at least 20% of the opposite direction of where the market is going. If the trend is up, great. The call options will increase in value and that percentage will climb. If it ever gets above 80%, leaving me with less than 20% in put options, I will force myself to sell and buy additional put options to make sure that I have that insurance policy in place, because the market will turn at some point. And when it does, you want that 20% to be there. And you'd be surprised at how fast that 20% can grow when the market turns in its favor. So I always maintain both. That's important. These other three rules, each rule is important for the overall profitability. You got to stay diversified. You don't want to overpay. I like to lock in profits on a regular basis. But those first two are critical, and I just wanted to highlight them. When talking about risk, the main idea is I'm not trying to increase the risk that you are comfortable taking. I want to maximize your reward for that level of risk. So let's say that you are a low risk individual. Great. We have a solution for that. We can use regression modeling and eliminate the most vulnerable stocks to a downturn. Great. Let's say you're a medium risk individual, and I would say the S&P 500 I classify that as medium risk. Great. Let's just try to maximize the reward you get for that given level of risk. Let's talk about commodities for a second. Commodities have about the same level of downside risk as the S&P 500. But very few people talk about commodities. Why is that? Well, it's simple. There are times when commodities do better than the S&P 500, but usually they don't. The reward isn't there. So that's why we don't generally invest in commodities. We invest in the S&P 500 because for the same level of risk, we get more reward. Well, I'm asking you, consider adding some options to your portfolio. For the same level of risk, you can get more. And then for those really high risk fighter pilot, risk absorbing clients, there is a high risk option, which is you increase your option percentage. I will not start people out at this level because of that high monthly volatility, but it is an option for those who are truly risk seeking. Why would you ever accept lower returns for the same level of risk? Maybe there's something I'm not thinking about. If so, please fire up your chat box and let me know what you're thinking. Why would you accept lower returns for the same level of risk? Now, for most investors, what is the right percentage of equity and options? We find that an 80-20 mix provides an excellent balance of risk and reward. And you can see from this graph how an 80-20 portfolio would have performed over the last few years. So in 23, the 80-20 would have done 35% return versus a very healthy 24% in the market. We've had 3 really good years in the market. The 2024 market did 23%, and basically the 80-20 stayed even with that. I also have some month by month numbers here so you can get a feel for the volatility. And it's not that an 80-20 portfolio will never have a down month. It will. In February of this last year, that 80-20 portfolio was down 8%. So that was not good. The point is, it's not down when the overall market, it's rarely down, I should say. There's no such thing as never, but it's rarely down when the overall market is down because the options pay off when the market makes big moves. The most challenging time for an 80-20 portfolio is when the market is pretty flat and there's not a lot going on. That's when the options tend to lose value and drag down their performance. But net, if you add all these up, the average per year of an 80-20 portfolio is 13% higher than, or has been over the last almost 3 years now, has been almost 13% higher per year than the S&P 500. Of course, the same disclaimers apply that we talked about earlier. individual results vary. Past results cannot predict, may not predict future performance. Performance calculations have not been audited by a third party, et cetera. Individual results vary. And that was only less than 3 years worth of data. Now, I didn't talk about 2022, but 2022 would have shown the 80/20 far exceeding the S&P 500. But in 2022, the only option portfolio I did was my own personal portfolio, and it did amazingly well. But I didn't include that because it did so well. It's just off the charts, and it was only based on one portfolio. So trying to be conservative here. But still, we're looking at less than 3 years. So let's we decided to do an analysis. It's called Monte Carlo simulations, where we can let a computer simulate the highs and lows of different asset classes over 200 iterations is what we did here, which essentially means 200 years. And what we're looking for is the worst case scenario over a 3-month period of time. How low does the market get? And this simulation over 200 years, the worst 3-month period was minus 19%. That doesn't mean the stock market never went down lower than that, but maybe it bounced back. But for the whole 3 months, it was minus 19%. The average return for the S&P 500 was 10%, and the worst total year was minus 32%. So we did that for bonds, the 60/40 traditional portfolio, and you can see the different options here, different portfolios. The 80/20 equity option portfolio, worst case was minus 16%. So we're comparing that with the S&P 500. So it actually did better in the short run, slightly worse over the full year. There was a minus 34% year versus minus 332, but essentially the same. The real difference is here in the performance. 10% for the S&P versus 17% on average for the 80/20 portfolio. Now, this is based on previous returns over the last 3 years, and these are all modeled results. So things could change, but it certainly looks attractive to do 80/20 over the S&P 500. Now, I want you to take a moment to look at these options and complete another poll. Which of these portfolios are modeled to have the most attractive risk-reward trade-off for you? You might still be in the bond camp and say, well, hopefully you're not in the bond camp. It's been a terrible last 3 years for bonds. But maybe you're still in the 60/40 camp because you want to keep that worst case scenario down low and you're willing to accept 3% returns. All right, we're getting down towards the end here. To summarize, we've got 4 different options that I think you might consider. A 60/40 portfolio, which essentially dilutes your equity, but also dilutes the ups and downs you saw on the previous page. Low return, at least using the data from the last 3 years. The modeled 90-day loss is not bad at only 12% loss. And we're going to talk for a second here about the Sortino ratio, but first let me explain the other options. So the market index, this is the S&P 500. You can buy an index, go to Vanguard. You don't need me or anyone else for that. Go to Vanguard, set up a fund, and just buy the index. And you'll have strong returns, roughly 10% per year. You will have almost a 20% drawdown in a 90-day period of time. You do have high crash potential, but going back to that first graph that I showed over 200 years, you're going to do great in the long run. This stellar equity option is with regression modeling, so not just the risk off model, but all of the models combined to find robust stocks. 3-year average 14% per year, modeled loss of minus 20%, essentially the same as the S&P 500. And we'll get to the Sortino ratio in a second. And then finally, the 80-20 mix. We've talked about this 3-year rate of 17% per year, modeled loss. So let's talk about the Sortino ratio. The Sortino ratio is a measure of reward divided by risk. In other words, how much incremental reward can I get for an incremental unit of risk? The objective is to maximize the reward for the given level of risk that you choose. The 60-40 portfolio does not do that. 36% is a terrible Sortino ratio. And I should point out, some of you may have heard of the Sharpe ratio. The Sharpe ratio is a fairly common industry standard for risk divided by reward. The Sortino ratio is almost the same thing. The only difference is the Sortino ratio only looks at downside risk, or downside deviation. So if your portfolio went up 50% in a given year, I don't think you'd be upset. You shouldn't count that against the whatever metric you're using to compare options. That's a positive thing, right? So the Sortino ratio does not consider deviation to the upside to be a bad thing. It only looks at downside deviation. And so for these 4 options, 36%, 95% for the market, so close to 100%. It's about where you'd expect it. Stellar clients were at 117% modeled based on the last 3 years of data. And equity plus option clients at 188%, which is outstanding. Just real quick before we end, this is how we typically work with clients who choose to use us instead of doing this on their own. Everything is through Schwab. You open an account with Schwab or take an existing account. It can be IRA, a taxable account, or a non-taxable account. But your interaction is with Schwab. They see your money. I never see your money. I don't handle your money. I refuse to. They send out your monthly statements. They send out your tax forms. You have online access to your Schwab account and can see trades that are happening in real time. The only thing you do regarding me is you tell Schwab, you grant a limited power of attorney for me to trade inside of your account. And so that's how I operate. There is a fee for that. It's roughly 0.1% per month. It's deducted. Schwab deducts that from your account. And then some clients want to go that step further and add options to their account. We would talk about that, make sure it's appropriate. And then there are there's an additional Schwab form you have to fill out. Additional fees do apply when trading options is a lot more labor intensive than trading stocks. But just wanted to give you a quick overview of that. Our results have been astounding. This is 2022 results. The market was down 20%. Our equity clients were down 4% when the market was down. And this is what I mentioned earlier, just my single IRA, it was up well over 100%. And so I don't really want to count that. Just one account. Started offering option accounts to clients in early 23. And you can see great results in 23, 24, and year to date this year. Great results on our equity side as well with our modeling. We're on track for 51% return this year on the equity side with downside protection. So goes back to that statement, having your cake and eating it too. That's what we're attempting to do for you. Normal disclaimers apply, as we've talked about before. But you might still want to do this on your own, which is great. If you do it on your own or do it with me, either way, you might want some additional advice. I would encourage you, again, to book an appointment with me. Take advantage of our bonus offers. Offer number 1, free copy of my book to the first 10 participants to book an appointment. And offer number 2, free risk analysis of your existing portfolio. Come to me, let me know what you have. There's no obligation in any of this. And I will tell you with individual stocks, I can say, well, here's what my model says that stock is likely to do in the next in the next downturn. Again, there's a strong error component for any one answer, but I think you can get a feel. If you give me a list of stocks, I can tell you roughly how vulnerable you are to the next downturn. So we're over 45 minutes. We're over 50 minutes now. So we need to wind down this call. I want to thank you for your time. We don't have time for a lengthy Q&A, but if you added something to the chat, I will send you an email and try to concisely address your question. Thank you very much. I look forward to meeting each of you on a one-on-one call. Take care.